Okay, here's some other tax planning tips related to HSAs. For high-income taxpayers, an HSA can be used to generate a tax deduction, even when the taxpayers are phased out of other retirement plan contributions. Deductions. The account can be used as a tax-deferred savings account, and the funds can be withdrawn after age 65 for any use with no penalty. The withdrawals will be taxed at ordinary rates like withdrawals from any other retirement accounts. So make sure that distributions from the HSAs are used directly to pay for qualified medical expenses if you're going to withdraw them and use them for medical expenses in order to avoid the 20% penalty. So in other words, you can't take the money out and then put it in your checking account and then write a check to your doctor. You've got to have the HSA pay the doctor. Comparison of traditional and Roth IRAs. So these are retirement accounts. These are not employer retirement accounts, although many of the same rules apply. So we've got two types of IRAs, traditional and Roth, and we're going to call these traditionals IRAs and we're going to call these Roths to distinguish between them. Okay, we have IRAs and Roths versus 401ks, 403bs, SEPs, and Simples. The 401ks, 403bs, SEPs, and Simples, these are employer plans, and again, the Roths and IRAs that we're talking about now are individual retirement accounts that you can contribute to outside of employer plans. So traditional and Roth IRAs, these are individual accounts, but they're not through the employer. Each spouse must have their own, so there's no joint accounts. And some of the same principles apply to IRAs as to employer-sponsored accounts. Now here, for your learning convenience, I have a nice chart that compares Roths and IRAs, so let's look at these individually. First, earned income requirement for a contribution. Yes, for both, but both can have a spousal IRA. So, income requirement for contribution. To be eligible to contribute, you must have earned income equal to or greater than the contribution. So, earned income. So, this has to be business or wage income. So, if you have interest income, that does not if you have any interest income, the interest income portion is not going to qualify you to make a contribution to these IRAs. So for example, John has earned income of $3,000, so his max contribution is $3,000. Henry has earned income of $50,000. He is 53 years old. His max contribution for 2018 is $6,500. All right. Spousal accounts. Betty works. Her earned income is $50,000. Her husband John, however, is not working. John and Betty can contribute $5,500 to her IRA and $5,500 to John's IRA for 2018. You can have spousal accounts for those who don't work. Also, you may want to hire children to qualify them for an IRA contribution. So Tracy has a home-based business. She hires her daughter Tamara to do clerical work or maybe to run errands for her. So Tamara earns $2,000 during the year. So Tamara can make a contribution to an IRA or a Roth. Now the downside is that Tracy has to keep track of Tamara's earnings and payroll taxes and file a W-2 form for Tamara unless she qualifies as an independent contractor, which she probably wouldn't in reality. But earned income qualifies you to make IRA and Roth contributions. Now, how much can you contribute? We've already alluded to this. You can see 2018, the basic contribution is $5,500, but if you're over 50, it's $65. For 2019, this has been indexed to $6,000 and $7,000, and notice these are the same numbers for both Roth and traditional. The contribution limits the total that can be contributed to both Roth and traditional. So if eligible, Helen could contribute $2,500 to an IRA and $3,000 to a Roth for a total of $5,500 for 2018, but she can't contribute $5,500 to each. Contribution phase out. Now notice for the IRA, there's no phase out based on income for how much you can contribute. For a Roth, there is a phase out based on income for how much you can contribute. So let's talk about those Roth IRA contribution phase outs. And as you can see here, the amounts are indexed, so they're different numbers for 2018 and 2019 based on filing status. So Roth, a single person with AGI of 130,000 under age 55 for 2018. So let's look here. This person's AGI is within the income phase out range for how much can be contributed. So what we do is we take 130,000 AGI minus 120,000 is the lower level of the phase out range. So we have $10,000. So we take $10,000 divided by this range spread, which for singles is 15. Look down and notice the married filing joint, the spread is only 10,000, but this person is single. So 10,000 divided by 15,000, 0.667. 5,500 times 0.667 is 3,669. That's the disallowed portion. So 5,500 minus 3,669 equals 1,831. So this person is only allowed to make a Roth contribution up to $1,831. Okay, deductible contribution. The traditional IRA, yes, has a deductible contribution, but it is subject to phase out of deductibility. The Roth is never deductible. So there's no phase out there. Now this phase out for the deductibility of a contribution to a traditional IRA, it looks very complicated. You just have to get used to these charts. And this is for 2018 and 2019. The numbers are slightly different, as is common. So let's look at this top chart. You see the first column is taxpayer is not an active participant. The second column says taxpayer is an active participant. The third column says one spouse is an active participant and the other is not. So what the heck are they talking about? Well, the taxpayer is an active participant. What they mean is that the taxpayer has a qualified retirement plan through work. So they have a 401k or 403b or maybe the Roth version of each of those. That's what they mean by an active participant. Now notice if the taxpayer is not an active participant and neither is the spouse, then the contributions are fully deductible, even if you have a very high income. So you have to look at this spouse by spouse, and you can define one as a taxpayer and one as a spouse. They just use that kind of antiquated language to distinguish one from the other. But either spouse can be designated on this chart as a taxpayer or the spouse. Doesn't matter. Anyway, but if they're not an active participant, then look, there's no AGI limit. So Evie works, her earned income is $600,000, her husband Lance isn't working. They can contribute $6,000 to Evie's traditional IRA and $6,000 to Lance's for 2019. So even with that very high income, they get a deductible contribution for their IRA. So neither is an active participant in a qualified plan at work, so their contributions are fully deductible. Here's an example of a single taxpayer who is an active participant. So Liam is single. His AGI is $65,000 before the traditional IRA deduction. 2019 we're talking about. He's an active participant at work. He can contribute $6,000 to a traditional IRA. So look in this chart, the middle column, taxpayer is an active participant for 2019. You see the single AGI phase-out range is between $64,000 and $74,000 of AGI. But his AGI is $65,000, so he is in the phase-out range. Now this is for a phase-out for deductibility, not contribution. So he can still contribute the full $6,000 to a traditional IRA. He can only deduct a portion of the contribution because he's in the phase-out range. The deductible portion is calculated as follows. It's the contribution limit times AGI minus the lower limit divided by the phase-out range. So we have 6,000 times 65,000 minus 64,000 divided by the range. And look down there for singles. The phase-out range is 64 to 74, so it's $10,000. So the non-deductible portion is $600 and the deductible portion is $5,400. Here's a married taxpayer who is an active participant, but the other doesn't work. So Chris and Kelly are married filing joint. Chris is an active participant. Kelly works, but she is not an active participant. Okay, so his marriage who is an active participant. The other is not. Okay, and so it's 2019. And so, so Kelly works, but she's not an active participant. So the couple's earned income from Chris's job is $135,000. Kelly earns $50,000. Their AGI is $183,000. Chris is an active participant. Now he's above the phase-out range, so he can make a traditional contribution to a traditional IRA, but none of it will be deductible. Kelly can make a deductible $6,000 contribution to the traditional IRA because their AGI is below the phase-out range for a non-participating spouse. So in this chart, Chris is going to fall in the middle column. Taxpayer is an active participant. Married filing joint, you can see he's above the phase-out range. On the other hand, Kelly is going to fall into this last column. One spouse is an active participant and the other is not. The spouse who is not an active participant may have a deductible traditional IRA contribution as long as their joint AGI does not exceed $203,000 for 2019. The deductible IRA contribution for this spouse is phased out between $193 and $203 for 2019, but their AGI combined is below that phase-out range. So Kelly can make a deductible contribution to the traditional IRA. Chris can make a non-deductible traditional IRA contribution. But does Chris have a better alternative? He can make a Roth contribution instead because he's under the phase-out limits for a contribution to a Roth. So if you have a choice between a non-deductible traditional and a non-deductible Roth, go with the non-deductible Roth. Okay, now we're going to look at the time frame for making the contribution. And notice it's the due date for filing the return, not the extensions, but the due date for filing the return. So, for example, your 2018 contribution does not have to be made until April 15th of 2019. So Samuel was eligible to make a deductible IRA contribution of $6,000 for year one, but he didn't have the money. What can I do? So he filed his tax return in February of X2 early, right? It's not due till April, showing the deduction of $6,000 on the return for an IRA contribution, but he hadn't made it. The return showed he had a refund coming of $3,000. So he received that $3,000 refund in March of X2. He saved $3,000 during the month of January, February, and March. And so on April 3rd of year two, he made a deductible IRA contribution for the year one of $6,000. So you actually can make the contribution after you deduct it on your tax return. Okay, so it's an idea. Okay, taxable distributions. The taxable distributions from traditional are taxed at ordinary rates, but Roth distributions are not taxed at all. So distributions from IRAs are taxed at ordinary rates except for basis recovery. If you make a non-deductible contribution to your traditional IRA, then you have basis equal to that non-deductible contribution. Samuel made $20,000 total contributions to an IRA over his lifetime. $12,000 were deductible contributions. $8,000 were non-deductible contributions. So Sam has a basis of $8,000 in the IRA. When he makes withdrawals, they will be partly taxable, partly not taxable due to basis recovery. Okay, but Roth distributions are tax-free and penalty-free if it's been at least 5 years since the first contribution to the account and the account holder is at least 59 and a half at the time of the distribution, because after all, this is a retirement account, right? So growth in the Roth investment over time can be huge. It can be a huge benefit of Roth, particularly for younger clients and really even for older clients. So let's compare required distributions. For traditional IRAs, there are required distributions, but not for Roth. So if you have high income taxpayers who really are not going to need that income that they've stashed away all those years, then Roth is going to be a better alternative for them. Otherwise, they're going to be required to withdraw that money and pay income taxes on it at probably a pretty high rate. Let's look at penalties. Again, 10% early distribution before age 59 and a half on the amount withdrawn. And similar for Roths, 10% early distribution before age 59 and a half, or if you haven't had the Roth 5 years. Now, there are exceptions to this, the early distribution penalties. And there are also ordering rules about distributions from Roth. Now, this is really good. Roth contributions, as you know, are not tax deductible. And so the taxpayer has a basis in the Roth equal to the contributions. So when a distribution is made, they're not taxed, right? But the contributions are deemed to be withdrawn first. So if you take an early distribution, then what you're deemed to withdraw first is what you've contributed and not the earnings. And there's no penalty on the distribution of basis. So again, the concept of basis recovery. So if Sam needs money badly before age 59 and a half, he can take it from a Roth penalty free as long as he only withdraws amounts equal to the basis, penalty free and tax free. So reduce gross income currently with a traditional IRA or in the future with Roth IRA non-taxable withdrawals. So take advantage of spousal IRAs. Hire children to enable them to contribute to an IRA. Contribute to a Roth if you're over the traditional income amount. Use a tax refund to help finance a contribution if the cash flow is an issue. Favor Roth contributions over traditional to take advantage of tax-free growth and penalty-free early withdrawals of contributions. Now let's talk about conversions from traditional to Roth. Okay, your client Marillion, he's upset. You've been explaining the benefits of tax-free income from a Roth over the benefits of tax-deferred income from a traditional IRA, but unfortunately, without consulting you, he made a $6,000 deductible contribution to a traditional IRA in a prior year. But you can cheer him up. You tell him you can convert that traditional IRA to a Roth IRA. The converted amount of $6,000 plus growth will be included in income. Why? Because the $6,000 was originally deducted from income. But it will then go into a Roth, and in a Roth, the money will generate tax-free income for years to come. Okay. All right. You also explained that the reason that all of that $6,000 will be taxable is that he doesn't have any basis in the IRA. Remember, basis arises when a non-deductible contribution is made, but all of Marillion's contributions have been tax deductible, so all conversion amounts are taxable because he had no basis in this case. Oh, backdoor Roth contributions. Your client, Cal Drogo, would like to contribute to an IRA or a Roth. His AGI is $200,000. He's still single. He's not an active participant in a plan at work. Now, what can he contribute to in terms of retirement plans? He can make a deductible contribution of $6,000 to an IRA because he's not an active participant. But tax-free growth and distributions would be better for him. But he can't contribute to a Roth because he's over the Roth contribution limit. Here's what you can do. Your client, Cal Drogo, can make the IRA contribution and then he can do a Roth contribution. He has no basis in the IRA because in his case it was all deductible. So all will be taxable when he does the Roth conversion, but he now has more money in his Roth. So he loves you. Okay, so for active participants who are over the Roth contribution limit, make a backdoor Roth contribution. Take advantage of converting traditional to Roth IRAs.